Bitcoin's price tumbled Monday evening, dropping to an intraday low of $87,629, its lowest price since dropping below $91,000 on November 19, 2024. The decline started after news broke that U.S. President Donald Trump would be going ahead with plans to impose a 25% tariff on Canadian and Mexican imports beginning on March 4, 2025. The announcement triggered a broader market sell-off, with major U.S. stock indices also declining as investors reacted to economic uncertainty and concerns over chipmaker Nvidia's earnings. The crypto market reacted sharply, with Bitcoin retreating 4.8% over 24 hours and down 12.7% over the past month. Michael Saylor, CEO of MicroStrategy, tried to frame the dip as a buying opportunity, posting on X that Bitcoin was on sale after his firm acquired 20,356 Bitcoin for $1.99 billion. Derivatives traders also felt the impact, as data from CoinGlass showed $140 million in long positions liquidated within 4 hours. The broader crypto market shed over 6%, falling below $3 trillion, $2.87 trillion. Ethereum and XRP each lost more than 10%, while Solana plunged nearly 15% in a single day. Despite Bitcoin's decline, its market dominance climbed to 62%, as trading volume surged to $126.66 billion, an 85% increase from the previous session. This paradoxical rise suggests that investors are shifting from riskier altcoins to Bitcoin as a relatively safe haven ahead of further economic volatility when U.S. markets reopen. Amidst these developments and general market chaos, Real Vision founder Raoul Pal has taken to social media to assure crypto investors about the situation and encourage them to look forward to what's coming. His post reads, "You guys all need to learn patience. This was 2017, very similar macro structure, 5 times 28% pullbacks in Bitcoin. Most lasted 2 to 3 months before a new high. Altcoins saw 65% corrections." This is not the first time Pal has pointed out parallels between the 2017 crypto bull market and the ongoing one. In his words, the current cycle will be almost perfectly correlated with the 2017 cycle while bearing little similarities with the 2021 cycle, which was a left-translated cycle. Pal argues that both the 2017 and the current cycles share a similar market structure, where Bitcoin experiences a series of significant pullbacks before reaching new highs. In 2017, Bitcoin saw 5 major corrections, each lasting 2 to 3 months, yet continued its upward trajectory. The present cycle appears to be unfolding in a comparable manner, with Bitcoin undergoing sharp but temporary declines before resuming its bullish trend. A key feature of these cycles is that altcoins also experience deep corrections during Bitcoin's pullbacks, often retracing by as much as 65%. Despite these severe dips, both markets demonstrated resilience and strong recoveries, suggesting a similar investor psychology and capital rotation. According to Pal, one major difference between the two cycles is the maturity of the current market. The cryptocurrency space today is more developed, with institutional investors playing a significant role in price movements. Unlike in 2017, when retail investors primarily drove the bull market, institutional adoption has provided increased liquidity, which could impact volatility. While Bitcoin remains highly volatile, its price swings have been somewhat more controlled compared to the wild fluctuations of 2017. Additionally, the regulatory landscape has evolved, introducing more scrutiny and legal frameworks that influence market dynamics. Governments and financial institutions are now more engaged with the sector, leading to both constraints and legitimization. Pal believes the 2021 cycle was cut short due to macroeconomic factors, including the Federal Reserve's tightening policies, which drained liquidity from risk assets. Unlike the natural conclusion of the 2017 bull run, which ended in a euphoric retail-driven blow-off top, the 2021 cycle lacked such a parabolic finish. Instead, the market was prematurely suppressed by external financial conditions. In contrast, the current environment shows signs of renewed liquidity, with central banks slowing down rate hikes and the potential for capital flowing back into speculative assets like crypto. This, in his view, supports a continuation of the bull market that is more aligned with the long and volatile path seen in 2017 rather than the truncated nature of 2021. Ultimately, while historical patterns provide useful insights, Powell cautions that each cycle has its own unique factors. He remains optimistic about the trajectory of the current cycle, expecting it to follow a similar extended growth pattern as 2017, albeit within a more mature and institutionally driven landscape. According to Powell, all investors must learn to filter out the noise, focus on the big liquidity picture, and spend less time staring at the charts, especially during moments such as this. He further argues that crypto asset prices will be significantly higher within the next 6 to 12 months, and all of today's chaos will be completely forgotten. Powell also recently retweeted a post from Chris Berniski, reminding investors that such bloodbaths and price declines are not unique to the cycle. The post reads, "In the middle of 2021, Bitcoin drew down 56%. Ethereum drew down 61%. Solana drew down 67%, and many others 70 to 80% plus. You can come up with all the reasons for why this cycle is different, but the mid-bull reset we're going through isn't unprecedented. Those calling for a full-blown bear are misguided." Bitwise CIO Matt Hogan has also suggested that the next phase of the market is a massive altcoin bull market, similar to Powell's predictions of Banana Zone Phase 2 or altcoin singularity. Look closely, and you can see the early signs of an altcoin bull market, Hogan begins in his post. Here are the leading indicators. The SEC drops Coinbase lawsuit, Jupiter flips fee switch, Ondo launches tokenized stocks, Uniswap launches Unichain. This is what happens when we have a fair regulatory environment. DeFi protocols can fix their tokenomics and tackle markets beyond crypto. My guess is the market significantly underestimates how much value there is in DeFi and how fast DeFi can disrupt non-crypto markets if it's unleashed. In response to an ex-user asking about the absurd amount of rug pulls and trash coins being launched, Hogan adds, "That is why alts are down. I suspect the key for the next few years will be differentiating the real from the scams. I'm not sure we'll have an alt season in the sense of all alts rising, but I do suspect real projects will be rewarded over time." In a more recent tweet, Hogan gives another super bullish prediction for crypto. The post reads, "Prediction: Crypto's total market cap will rise by more than 100% next year, while the median asset will fall by 90% plus." When asked to clarify if this means the increase in market cap will come from Bitcoin and a couple of other major cryptocurrencies, Hogan adds, "Yes, just across the board. Market cap weighted. I suspect there will be a number of big winners, but lots of small projects will fail. That's normal for what it's worth." In other news, the cryptocurrency and digital assets space has secured two major regulatory wins this week. In a major regulatory development, the U.S. Securities and Exchange Commission, SEC, has withdrawn its probe into the NFT marketplace OpenSea, signaling an end to what many saw as an aggressive crackdown on crypto innovation. OpenSea CEO Devin Finzer announced on X that the SEC is closing its investigation into the company, calling it a significant victory for creators and builders in the digital space. Finzer stressed that attempting to classify NFTs as securities would have been a backward step that misinterprets the law and stifles innovation, ultimately placing unnecessary barriers on creators of all sizes. Last year, Finzer revealed that OpenSea had received a Wells notice from the SEC regarding potential securities law violations, a notice intended to warn of possible legal action rather than an outright accusation of wrongdoing. At the time, Finzer warned that targeting NFTs could jeopardize the creative landscape, putting hundreds of thousands of online artists and startups at risk, many of whom lack the resources to defend themselves. He even offered to contribute $5 million to support NFT artists and startups facing regulatory challenges. The commission has also decided to drop its lawsuit against Robinhood Crypto, the cryptocurrency division of the well-known financial services company, and will not pursue further enforcement actions. Robinhood CEO Vladimir Tenev welcomed the decision, stating that the investigation should never have been initiated. Speaking on X, Tenev remarked, "The SEC closing its investigation into Robinhood Crypto is a win for justice and the rule of law. Now, it's time to focus on pro-innovation policies that unlock the full potential of digital assets in America. These latest moves by the SEC follow its recent decision to drop a lawsuit against Coinbase, the nation's largest crypto exchange. Coinbase CEO Brian Armstrong hailed this development as a major win for the rule of law. Collectively, these actions indicate a significant shift in the regulatory approach toward the crypto sector, one that could pave the way for greater innovation and fewer obstacles for digital asset creators and investors alike. Please share your thoughts on Raoul Pal's and Matt Hoogan's tweets and the latest regulatory development in the cryptocurrency space. If you liked this video and want more like this, don't hesitate to give this video a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.